Hi, this is David Ware with Ware Financial, and it's my pleasure to present the second quarter economic review of 2025. So as you watch this, please keep in mind it is a review of the months of April through June. The Trump administration started the third quarter with a bang as the One Big Beautiful Bill Act became law on July the 4th. We will briefly review some of the key items in that bill, and we will share more specific details of that act in the near future. At our firm, we partner with clients and believe an educated client is our best client. While we always try our best to help you, when it comes to your finances, we believe that knowledge is power. One of our missions is to share with clients any knowledge that can better help them make informed decisions. If this past quarter and the first half of the year aren't a testament to a long-term investment philosophy and staying the course of a well-devised plan, then we are not sure what is. If you left planet Earth on January 1st and returned on June 30th, you would see that the S&P 500 started the year on a high note and achieved a new high on June 30th. This is great news for investors who stayed the course. However, if you had sold out of the market when many others panicked in late March and early April and tried to time a re-entry point, you could have missed some of the quick move upward. As the charts show, the second quarter kept investors on a roller coaster ride. The good news is, after early April, when President Trump placed a 90-day pause on trade talks with many countries including China, equities made a strong rebound. By early May, the S&P 500 regained its year-to-date losses and entered positive territory for the year. After advances of approximately 5% in both May and June, the S&P 500 closed the second quarter at all-time highs, leaving investors who stayed with equities feeling joyful once again. The S&P 500 closed the quarter at a record high 6,203, up 10.57%, and posted its best quarter since December 2023. The Dow Jones Industrial Average closed the quarter at 44,077, up 5% for the year. The Consumer Price Index is a key statistic used to measure U.S. inflation. It has slowed considerably since it surged to highs in 2022. As of May, the year-over-year CPI, otherwise referred to as inflation, was measured at 2.4%, which was slightly higher than April. The June numbers, released in early July, show overall inflation still reasonable at a 2.9% increase year over year, but core inflation had a slight uptick for the month to 2.7%. Overall, inflation is still trending in the desired direction. As of June, the tariff impact has been slight, if at all. According to economists, the big concern is whether any of the tariffs levied by President Donald Trump will reignite inflation in the coming months. Obviously, we will continue to be watching inflation results. So moving to interest rates, the Fed closely watches economic activity, which continued to expand at a solid pace during the second quarter. The unemployment rate remained low and labor market conditions remained solid. However, inflation concerns because of tariff implications during the second quarter of 2025 caused the Federal Open Market Committee to maintain interest rates in the range of 4.25% to 4.5%. The news did not affect investor sentiment, and stocks remained steady following the announcement. There are still 4 more meetings scheduled for 2025. However, until the trade policy is finalized, even the labor market remains strong. A holding pattern for interest rates could remain. Bonds are considered a choice in lowering volatility, but even they were not exempt from volatility in the second quarter, and they remain sensitive to the continued uncertainty. The 20-year Treasury note started the quarter yielding 4.56% and ended the quarter at 4.79%. The 10-year note started at 4.17 and ended at 4.24. So the outlook for bonds in 2025 remains unclear. There is still certainty or uncertainty about inflation and interest rate trends. A big player in determining the direction of inflation and interest rates will be getting more clarity on tariffs. We consider using bonds when they are appropriate for portfolios, and when we do, there are several things we take into consideration, including a client's risk tolerance, time horizon, and overall investment goals. Safety comes with a cost, and even though interest rates have risen, many major banks are still offering low interest rates to savers. According to Barron's, the average bank money market on June 30th, 2025 was 0.39%, and the average 12-month CD rate was 1.76%. As you can see, they have decreased over the last 12 months, providing savers who take this route with even lower returns. For anyone who is interested in exploring better sources of interest rates, please contact our office. We want to remind you that we encourage long-term investing. As you examine a 45-year chart of equity returns, we are once again reminded that over a 40, 30, or 20-year time frame, even with some very severe downturns, historically, long-term investors have been rewarded. As we move to the second half of 2025, here are some key takeaways from the second quarter. The S&P 500 recovered from correction territory and once again set new highs. U.S. inflation continues to decrease. It was 2.4% in May, down from 3% in January 2025. The federal funds rate remained unchanged at 4.25 to 4.5% as of June. The Feds are still forecasting rate cuts in 2025. The unpredictability surrounding tariffs continues to be a key player in the direction of inflation and interest rates. Volatility in equities is likely to continue. Focus on what you can control and minimize your exposure to inflammatory news. We will continue to provide you guidance on any issues we feel may affect your personal situation. Maintaining a well-diversified, long-term focused plan has historically served investors well. And finally, remember that we are here to discuss any questions or concerns you may have. We know that this is an economic update, but on July 4th, the President signed into law the One Big Beautiful Bill Act that may impact the financial planning of millions of Americans. We will be sharing information as we finish analyzing this bill, but here are a few items within the bill that could impact you. The currently lower tax brackets will remain. The Tax Cuts and Jobs Act, income tax brackets were going to sunset at the end of the year, but now these brackets are permanent, saving millions of taxpayers from a tax increase. Higher standard deductions have become permanent. The higher standard deduction becomes permanent and will increase to $15,750 for single filers, $23,625 for head of household, and $31,500 for married individuals filing jointly. In addition, there is a new additional standard deduction of $6,000 for those over the age of 65 that will last through 2028. State and local deductions, the SALT deductions, is raised from $10,000 to $40,000 with a 1% increase in the cap each year through 2029 before returning to the $10,000 limit for 2030. The deduction is reduced for higher income taxpayers, starts to phase out after $500,000 of income. The estate tax exemption was increased from $13.99 million to $15 million for individuals and from $27.98 to $30 million for those married filing jointly. These new laws have some limitations and guardrails that we are currently analyzing, and we are planning to address the details behind the changes that impact our clients in future communications. So there's a lot of work for us to work on, but we want to end this update by once again thanking you for your trust in us. One of our main objectives is to keep our clients informed, and we appreciate you taking the time to watch this update. Please feel comfortable sharing this update with anyone else you think can benefit from it.